I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy again.
I think a lot of people are commenting on the fact that the only other 2 times where we've had a 50 basis point rate cut in modern history, it has been just before a recession.
The U.S. Federal Reserve's decision to cut interest rates by 50 basis points for the first time in over 4 years has raised concerns about an impending recession in the world's largest economy. Experts point out that the central bank has only implemented such a significant rate cut 3 times in history, during the 2001 crisis, the 2007 Great Financial Crisis, and the 2020 COVID-19 pandemic. Each of these cuts was followed by serious economic downturns, leading many to believe that despite official assurances of stability, the Fed's actions signaled deeper problems ahead. Billionaire investor Chamath Palihapitiya and venture capitalist David Sachs have weighed in on the decision, noting that starting with a 50 basis point cut, rather than the expected 25 basis points, suggests the central bank is preparing for turbulent times. They warn that Federal Reserve Chair Jerome Powell and other FOMC members appear to be in panic mode, though they are attempting to maintain a facade of calm to prevent widespread market instability. Both believe that further rate cuts will likely follow before the year ends, potentially triggering a full-scale money-printing cycle by next year. Similarly, Raoul, CEO of Real Vision, predicts more quantitative easing and liquidity injections in the near future. In a recent post on social media platform X, Powell alluded to the Fed's upcoming actions, saying, "I love the smell of more cowbell in the morning," and noting that markets typically lag global liquidity by about 10 weeks. He also mentioned that recent Chinese stimulus efforts haven't yet impacted the data, suggesting more economic shifts are on the way. Chamath and Sachs shared their insights on this development in a recent episode of the All In podcast, highlighting what the Fed's rate cut could mean for the U.S. economy in the months ahead.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
The more likely scenario, Chamath, is this similar to the dot-com great financial crisis or similar to 2020?
Well, I think 2020 you have to put it a big asterisk because the question is what would have happened had there not been COVID and had there not been an entire global shutdown. So if you go back to that chart, you could probably just extrapolate and cut out that part that's flat, because the part that's flat from 2020 to 2022 was largely artificially created because on top of that, we injected so much money into the economy. The reality is we probably would have raised at some rate of change that you could have predicted from 2016. So what do you take away from that? I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy again. So the reason why markets tend to fall once the rate cut cycle starts is because the next couple of quarters sort of demonstrate what I think the Fed is expecting, which is that there's pressure in the economy. We have not seen that flow through in earnings or in how companies describe markets on the field, by and large, except for a few. So I think this part of the cycle now will be about all of these companies telling us whether there's nothing to see here or whether there is actual real pressure. And if there is real pressure, it'll probably look like the several times before where you're just going to have to contract the value of financial assets because they're just not worth as much when they're earning less.
I think a lot of people are commenting on the fact that the only other 2 times where we've had a 50 basis point rate cut in modern history, it has been just before a recession. So I think this happened in 2001, 2007, right before the recession. And the Fed had to do a dramatic rate cut because they could see in the data that things were weakening. So a lot of people are asking the question, well, is that what's going on here? Now, Powell's comments, though, are indicating that the economy is in good shape. He said the economy is in very good shape, that basically indicating that they had tamed inflation and that they would look to cut another 50 basis points this year. So Powell's rhetoric is, in a way, at odds with the magnitude of this cut. So why didn't they just cut 25 basis points? I think people are trying to figure that out. Yeah, if the economy's hot, why wouldn't you tiptoe into rate cuts and just do 25 now?
That's the key thing. If you look at the dot plot, and if you look at where the smart financial actors are betting where rates end, so it's hard to sort of like look at any point in time, 50 now, 25 later. What does it all mean? It's very hard to know. But what is much clearer is where do we think terminal rates will be even in the next 18 months? And it is dramatically lower from where they are now. And I think that supports, Sachs, that argument that you just made, which is if you're going to basically cut this aggressively over the next year to year and a half, by the estimates of very smart financial actors whose job it is to spend every day observing the Fed, then they must see something. Because otherwise, as you said, you could take a much more gradual approach.
According to Raoul, it's not that the Federal Reserve is reacting to new information, but rather that they are following a long-standing strategy that central banks have adhered to since the Great Financial Crisis. After the 2008 crisis, there was an informal agreement among central banks to keep printing money periodically to support their economies and prevent the total collapse of the financial system that should have occurred during that period. This is the foundation of Powell's Everything Code thesis, which he has been discussing for years and has consistently aligned with central bank actions. Last year, when many were predicting a global recession, Powell argued that it wouldn't be allowed to happen because central banks would intervene before the situation became critical. He still holds this view, suggesting that the Fed and other central banks will have to cut rates further in the coming months, as part of the 2008 agreement, and to manage their massive debt burdens. In a recent tweet following the Fed's latest announcement, Powell pointed out that many are overlooking the fact that the real Fed funds rate remains too high for the current economy, and too high to manage or reduce existing debt. He predicts that rates will need to go lower to address these issues.
And so I think that the smart financial actors are guessing recession or guessing contraction. I think what they're also guessing is similar to non-farm payrolls. We're going to go through a couple of difficult GDP revisions, probably downward. And I think that will have an impact to people's sense of how the economy is doing, even more than what their sense is today, which is already teetering on it's at best okay. And I think all of that has to play itself out. So it's going to be a very complicated and dynamic fall in that respect.
Just in terms of the labor market, what do you see, in companies right now, hiring, the talent pool, et cetera?
Well, I mean, in tech, things are pretty good. I mean, they're not as absurdly frothy as they were during the bubble of 2020 and 2021, but things are good. You have this huge AI tailwind now, and there's just a ton of investment going into AI. There's a little bit of a tale of two cities going on. If you're in AI, things are really bubbly, and if you're outside AI, they've returned to much more normal levels in terms of valuation and company operations, all that kind of stuff. Just to go back to the state of the economy for a second, the reason why a lot of people were predicting a recession, including me for a while, is that the yield curve inverting has been an almost perfect gauge of whether a recession is coming. It's when basically the Fed raises short-term interest rates above long-term interest rates. Normally, long rates are the ones that should be higher because investors demand a higher rate of return to tie up their money for longer. So something's really off and kind of broken when short rates go above long rates, the yield curve inverts. And it's always been the prelude to a recession. But the recession doesn't come when the yield curve inverts. It usually comes when the yield curve de-inverts. Right. And the reason for that is because the Fed now sees weakness and dramatically cuts the short rates. So in other words, it jacks up the short rates to control inflation. That works. It trickles through the economy cools down. And then the Fed says, oh, shit, maybe we've overcorrected. They slam on the brakes and then they cut rates to basically make up for the effect in the economy. So the yield curve has finally de-inverted, and the question is just, do we now get that recession, or did the Fed manage this to a soft landing? I don't think we know. I'm not like calling a recession, but this is the thing that people are concerned about.
Yeah. Well, Sachs, we were talking about AI in the group chat, right?
Yeah. I think it's now becoming really clear that call centers are going to be the first really big disruption caused by AI.
Yeah.
I mean, all the level 1 customer support is going to get replaced by AI. I mean, LLMs plus voice, because, OpenAI just released their audio API. You saw that at the All-In Summit, we released a Mearsheimer AI.
Yeah.
Where we trained it on all of his work, and you can go to mearsheimer.ai and ask it questions, and it will tell you the answers in his voice because we cloned his voice using Resemble AI. Anyway, so AI can do voice now, and it can be trained extremely well on large data sets to give you answers to questions, which is pretty much what customer support is. So I think it's now becoming clear that I think within the next 2 to 3 years, you're going to see a
Raoul Pal is also convinced of the transformative power of artificial intelligence and other disruptive technologies like robotics and energy storage, predicting they will reshape the world in the coming years. On Tuesday, the Real Vision CEO highlighted a tweet featuring a video of OpenAI's Dario Amodei discussing how AI has become the most cost-depreciating technology ever. In the video, Amodei explains that the cost per million tokens for OpenAI's models has dropped from $36 to 25 cents over the past 18 months. Reacting to this revelation, Pal tweeted, "As I've said, AI is a deflationary nuclear bomb. The cheaper it gets, the cheaper everything gets. Electricity is the other one. No one believes it now, but we are reaching the deflationary tipping point there too, which accelerates AI and cheaper energy." Pal believes that this rapid acceleration in AI and cheaper energy will help tackle the world's productivity and massive debt challenges. He envisions AI and robotics creating infinite humans to boost productivity, making it easier to manage the global debt burden. According to him, this AI revolution will kick off around 2030, fundamentally altering the global economy and financial markets. Pal advises investing aggressively before this AI renaissance takes hold, as he believes the world will become unrecognizable by then. He emphasizes that these technological advancements will drastically change industries and economies, making now the time to capitalize on the opportunities ahead. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.